Welcome to my channel, Germain Talks, and I hope you're doing safe and excellent as always. Today, I have come up with the topic of mergers and acquisition, and with me, I have Professor Michael Zahaby. Uh, Professor Michael Zahaby is currently a professor at Florida Gulf Coast University. Prior to his retirement in 2017, he held 4 chief risk officer positions in 4 financial institutions, two of which were on Wall Street, one with a private equity firm, and the fourth one was a regional community bank. Professor Zahaby has financed over more than $1.5 billion in acquisition over his 40 years in banking and finance. He has a BS from the Ohio State University and an MBA from Thunderbird School of Global Management. Quite a person to speak to in terms of mergers and acquisitions. Welcome, Professor Zahaby. How are you doing today?
Thank you. I'm doing terrific. Thank you. Thank you for the great introduction. I appreciate it.
All right. So I would like to get into the interview. One of my first question, Professor, is that money right now is rare and is sucked out of the markets due to the COVID crisis. At the same time, as a consequence, valuations are all-time low. So can you please take us through the M&A activity in North America in particular and globally during the COVID times? And how would it look like in a near future?
Sure. Actually, private equity firms are flush with funds and the money is sitting on the sidelines right now, very anxious to get deployed. They kind of are starved for yield, particularly since the Federal Reserve has flooded the market with resources and is keeping rates at historically low levels. So what happened is the transaction velocity has slowed down. It has slowed down for a variety of reasons. One of which is that the diligence process has kind of slowed down. Typically, it takes a year and a half for the velocity for the transactions to take place. You meet management, you get to know each other, you travel, you check all the plants. Well, because of slowdown in travel, that's not taking place. Because of the mobility has been kind of slowed down because of that. And the diligence process has also slowed down. More importantly, as you price transactions, it's difficult to price a revenue line because the revenue stream is kind of either uneven or unpredictable. Typically, you look at the historical number and go forward and project forward. So the question is, what do you project to? The uncertainty as to where revenue streams are headed is kind of daunting. So a lot of folks are sitting there wondering where we go from here, where does the revenue go from here, and where does EA go from here? Now there's a new term that is coined. Instead of EBITDA, it's EBITDAC. So earnings before interest, depreciation, amortization, and COVID. So that's the revenue stream you had, but that's not the revenue stream that's going forward. And now how do you price a transaction? Typically you do it as a multiple of sales. Well, you don't know what the sales really are going to look like or wind up to be, just because of the uncertainty. And just, you can't model that. There's an advantage though. Those that are, as you know, there are two sorts of buyers. There's a strategic buyer and there is a financial buyer. And the strategics have an advantage. We can get into this later, but the strategics have an advantage because they're already into the space. They already have a platform company. They know where they're living it. The financial is on the inside, looking in, so he doesn't have that much inside knowledge. Their inside knowledge is acquired, whereas strategic is living it and experiencing it because they're already in the segment, in the space.
Okay. Uh, Professor, the second question what I have from this is, what are the sectors where we are still seeing higher price to equity ratios and which will give us more returns, like in terms of the M&A?
Unfortunately, the crisis has created winners and losers. And so the winners, of course, are tech, healthcare, and all sorts of IT, just because of access and the need for digitalization. So this is where the higher valuations are. If you looked at today's news as to how the Dow is going to get priced, they've added more technology companies, and like a company like Amgen and a company like Exxon is not part of the Dow calculation. So this is what the crisis has created. Now, cyclicals and financials are probably most undervalued. Financials, of course, because of the compression in NIMs, net interest margin, and the cyclicals, again, just because of the nature of the crisis we're living. So, but again, from a return point of view, and I'm not a Wall Street pundit, the opportunities lie in value stock and in the value segments. Those that have been beaten down by the crisis and are expected to come back eventually.
Okay. My another question, Professor, is that M&A in general is something which happens from above, like from the executive level, and instead of going from below. So what should be the due diligence from the bottom, at the bottom level, which should be done by the acquiring company uh, in order to, and due diligence, both, like I have read now that DD is done even for the acquirer company as well. So what should be the due diligence architecture look like?
Well, let's talk first about what drives M&A activities.
Okay.
Okay, so the M&A drivers are low growth. You happen to be an industry that's not growing as fast as others are, coupled with anemic market share. You have a small share, it's a fragmented share, so that is ripe for consolidation. Stale management, perhaps management is getting on in age and they're not very motivated. And mature industries, certain industries like energy, that's a mature industry, and and if you've been tracking what's happening there, is a lot of M&As happening there, a lot of acquisitions, and then the change dynamics of that particular industry. We're going from fossil fuel to green fuel, and highly competitive forces. Some segments like retail, for instance, heavy competition. And then the corporate culture. I mean, does this company have a survivor mentality, or is ready to be acquired by someone else? There are two types of players, and we mentioned that already, for transactions. There's strategics, and these are those already operating in this sector with the platform company, and those buyers can pay more because all you have to do is make the acquisition, eliminate the overhead, mount it on the platform, and you're off and running. For them, the transaction becomes either what we call a tuck-in. You just tuck it into what you have already, or a bolt-on. You bolt it to what you got, and you're off and running. The second one is the financial buyer. A financial buyer are those that are kind of aspiring to be in a space and come to the transaction as a standalone company without an existing infrastructure. All the more reasons why they should not overpay. They can't afford to overpay, because if you do, then the leverage kind of goes diametrically higher, and then your learning curve. By the time you get in and you learn what's going on in the company, and you learn the industry, it takes you a while. So
Yes.
meanwhile, you're losing ground. And then you have the issue of overhead. Since you have a single standalone company, whereas a strategic, he already is in the space, he can eliminate overhead pretty easy
Oh
between
yeah.
companies.
So, like my point is that from the due diligence perspective, if I'm out in the market, if I'm if if I'm out in the market, or if I'm hiring an investment bank to do a valuation of a particular firm, or now I have more or less narrowed down a particular company. Anything specific in the due diligence, what you, if you can reflect upon?
Well, if you're already in a space, you know who your competitors are,
Hmm.
and that's what I meant by that's why you're strategic. That means you already have an advantage. You have a list of competitors. You know who you bring shoulders or elbows with in the market. You know who's coming at you. So, but the diligence exercise are multifaceted and kind of, and the scope depends on what the buyer is buying. So, give you an example. There are two types of purchases. There's an asset purchase, right?
And there's the share
And there
purchase.
is a stock purchase.
Yeah.
So the asset purchase is the easiest. Why is that? Because it comes with very little liability and it's a defined set of risks. Okay,
Yeah.
so it is also very easy to integrate. So assume you're purchasing a product line with inventory. So what you're getting is that inventory, uh, that product line, and it's easy to put together. You just bolt it on what you have, or as the salesman puts it in their bag, and they're off and running. A stock purchase is a little bit more tricky, a little bit more complex, because with it comes multidimensional risks and liabilities. It's kind of like buying a house. You really don't know the condition of the house until you move in.
Yes.
And as you live inside there, then in essence, you find out more about the plumbing, you find out more about the electrical work. So for that, if you're coming in de novo, especially if you're financial, you need a quality of earnings. That means you have to go back and reconstruct all the earnings from zero, and shipping tests. And all the nuts and bolts of this, invoices, verifications, customer verifications, and so on. It requires an audit. You need to get a firm audit or a re-audit, and these are not cheap. You need to take a look at all their contracts, all their contractual obligations, and do an operational review. Check their supply chain management, both sides, this side and that side, to make sure that these contracts are valid and there's nothing hidden in these contracts. So again, this is like buying a house. On the surface, it looks pretty good, but until you move in, there's no telling what you're gonna find. There's no
My,
telling.
I, to that, I won't say you use the word contracts, and I come from sourcing world. So I make my living out of negotiating contracts. So my question is that what are the potential issues which should be done pre and post merger to make sure that the contracts give better outcomes? Like in
Well,
terms of contract harmonization, we should not be like in a situation where we have we have bought a company which is we are in business of making apples, and that company is not even bananas but in the business of destroying apples. So here we have bought a company which is completely 180-degree opposite. So what should be done?
well, this is where a strategic has an edge. For them, the diligence exercise is much easier because they are onto the supply chain. They know where the sourcing is coming from. Whereas this is more of a climb, and the climb of a wall of worry for financial, because you really, since you're kind of on the outside looking in, you have to decipher this. You have to decipher what it means. I hope I answered that question as much as I could.
Yeah,
I mean, the advantage is always with the strategic in terms he can bid better, he can bid more, he knows the space. For them, they know what to do with that company. You take a competitor out. Sometimes you don't want to take that competitor out because they're better off dead than alive. You just let them rot on the side of the road and just keep moving. Sounds cruel, but that's how the world operates. And there's the concept of value, right? So when you are pricing a transaction, you're looking at a transaction, you're always asking the question, where is the value? Is the
Yes.
value in the customer list?
Yes.
Is the value in the supply chain?
Yes.
Are they going to get you a new product? Is there a patent and trademark that's going to get you there? So you're taking apart the balance sheet and trying to determine where the value is. And it could be there's no value. You already have most of that. Or you're coveting a customer list. They have maybe a very loyal customer list that you really would like to have. So you kind of have to cut through to where the value is on the transaction and the acquisition. I mean, why are you buying the company if you're not going to get a value? That's the
Yes,
concept.
yes. I get you. So you try and say that one has to be vigilant enough, number one, and one has to be cognizant, and like you're just not driven mad by just having some cash in your balance sheet that I'll go ahead and acquire a company. You have to do a complete nosedive into, like, you have to go through the construct of the company which you are intending to acquire.
Yeah, the Japanese are pretty good at this. They, in essence, perfect what they do.
Okay.
They don't reinvent what they do. They just take it, hone it, engineer it, re-engineer it, take it apart, take it this way, take it that way, customer test it this way, and the products that come are byproducts, are offshoots of that product. They don't go into something de novo with no knowledge, with no experience, right? There was a commercial years ago about this guy in the operating room, and they asked him, have you done this before? And the patient is laying on the table. And the answer is, no, but I slept at a Holiday Inn Express last night. So that's what I mean. If you're an insider, if you have that skill set versus you've seen it done, let me guess how I could do this. I mean, especially if you're writing a big check.
Absolutely.
Yeah.
To that I want to say that, like, M&A is always being a fancy word, a buzzword, or it attracts a lot of attention. But aren't we also seeing divestures and spin-off in few of the sectors at the moment, where the leadership is facing challenges on the shareholder? Because right now the shareholders are also up in arms that if you as a company, you are affected by COVID, or these are trying times, then give my money back in terms of dividend. So are we seeing any like load shedding in terms of divestures and spin-off?
Well, I have pretty, I'm pretty opinionated on that topic. Let me share with you my thoughts. Let me share with you my thoughts. Excess cash on a balance sheet is like a magnet to activists. So activists are always looking at companies with huge cash balances.
Oh, yeah.
And no different than Carl Icahn calling Tim Cook and saying, hey, how about some of that cash for the shareholders? So what you do with that cash is really interesting, because companies typically don't want to, especially management, don't want to take a massive risk. So do you, in essence, buy back shares and suddenly improve the earnings per share? Because the calculation goes net income divided by number of shares outstanding, right? So if the number of shares outstanding is less, then you have a higher earnings per share.
Yes.
So that to me kind of lacks creativity, meaning you exploited that cash to expand into capital expenditures, make a suitable acquisition, expand the plant, do a product extension, you kind of use that cash to pretty the balance sheet. It's more of a financial maneuver, financial transaction. Or you want to quiet the activists and give them the cash and just go away. Um, so, so the beauty is the transaction velocity. All right, so you're generating a huge amount of EBITDA. What do you do with all that cash? Do you improve the plants and equipment? You get more efficiency out of the operation, or do you just buy back shares and there's no risk in that? Very low risk. As a matter of fact, shareholders will be happy, activists will be happy, the street will be happy. So it's a low risk to do this and kind of lacks creativity.
Yeah.
Whereas if you're a risk taker and if you understand your business and you want to expand the business, expand your footprint, then you can deploy that cash in serious manner. But that's taking a risk. That's stepping out. That's you're now suddenly become not only the management, but the board has to answer as to why did you just buy shares? Why didn't you buy, or why did you buy this company? I mean, and you know, most acquisitions don't work out too well, particularly if you're buying, if it's a stock purchase, because
Yes.
especially in banks, I mean, the bigger issue in banks, two different cultures colliding together. And
Yeah.
I've seen this because I was on a diligence team of several banks, and you go in, and you make the acquisition, and you check each other out. It's like a dating thing, and then you come together, and then the chemistry is not there, and then well, we used to do it this way, and the other side goes, no, that's not how you do it. We used to do it this way,
Exactly.
and then it becomes a little bit. Whereas if I'm making an asset purchase, I just buy that product, use it what I've got, I just give it to the salesman. He adds it to the product offering. We're off and running.
Exactly. Exactly. Well, okay. So more or less you have answered my question, but my next question. But do you think like right now, given the COVID situation, this is the best time to give dividends to the shareholder, or this is the time to like hold your cash close to you yourself and plow it in your business?
Well, that's a complex question. It's a good question, but it's a complex question because we are living in transformational times. We really are, and M&A kind of is reflecting that current dynamism with all these changes. And certain segments are doing very well. So if I am like, and we started off by saying that clarity is not there because we don't know where the revenue stream is going, and some businesses, they don't know where the next customer is coming from. So it's difficult to make that judgment, but it's a good opportunity to consolidate market share. It's a good opportunity to add to market share. It's not a good opportunity to venture into unknown territory. It's not. It's not. And values are excellent now. So the judgment is, if I make my move now, do I get it at the right value? Because the other side is hurting and looking for a lifeline, and looking for someone to rescue them. Or do you kind of let it marinate a little bit more, and then I get a little bit more, I can squeeze a little bit more out of it. So that's what I mean. It's a little, it's a difficult judgment.
But Professor, would you kind of sacrifice a new upcoming investment in your R&D? Like, would you spend $50 million in a new R&D? Or second is to improve an existing assembly line setup? Or would you like to give that $50 million back to your shareholders?
I think you can do a combination, but I'm more Japanese. I'm Japanese. I'm not Japanese, but I mean, I take my product line and I see what I can do with it. I take my customer base and see what I can do with it. I don't venture into places where I don't. And maybe that's the chief risk officer in me. Where I've seen prudent management do is look internally. They become a little bit internally focused and say, okay, of all the product lines we have, of all the divisions we have, which ones are survivors? Which one
Yes.
have the higher potentials? Which ones are, we've really ran out of road with them, and as a result, we let them go. We either sell them or reposition them, or quite take them to the back and get rid of them. So it sounds pretty cruel, but this is the time where you should internally focus and reload, and kind of recalibrate where you're headed, because the environment has created an incredible set of opportunities for those that can do self-evaluation. You know, you can be smug and you can say, well, I don't need to do anything, I'm in a good place. Or you can say, you know what, it's time to recalibrate, take a look at what we've got. And you have to make some hard decisions, because like I said, some divisions, some businesses, some segments, they ran out of road. You know, if like there's no more place to go. Like a mall, for instance, if you're a retailer. The interesting part about, and take some of my last stop from career-wise with a private equity firm that did full capital for franchise restaurants. And if you are, we'll spend a minute on M&A there. If you are an independent restaurant operator, you are in a bad place. You are in a very bad place. If you are a franchise operator, or if you franchise restaurant, if you're a chain, you fare much better. And the reason you fare much better is, one, you have the ability to pivot into drive-throughs. You have curbside pickup, digitization. More importantly, you have access to the capital market, especially if you're a public company. And private equity firms are throwing money at these systems, and some systems, not all systems. And you see a company like a Chipotle that was in deep trouble vault, in essence, because they pivoted quickly, they looked in inside, and they said, what can we do to get this thing moving? So you contrast this by independent grocery store chain, or contrasted with a small mom and pop operation. It's sad. It's sad, because in America, what drives the economy is small business. What drives the economy is middle market business. And these, specifically those in retail, are outmaneuvered, outgunned. If you're a hardware store, I feel your pain. But because you can get that product from a Home Depot, you can get that product, and consumers more confident going into Home Depot because they know they are that Home Depot's cleaning a lot and doing the right things in there. The store is ship shape, whereas you don't want to get out of your cart to go in the Ace Hardware store, because it's a small store, it's a small environment, and you don't know what you're going to get if you walk inside the door. Everybody is with masks at Home Depot, they're mandated and so on. So I don't know. This virus has kind of
Professor
transformation.
I've come to the end of the interview, but I would like to know any closing remarks. And one of my favorite sectors is actually startup. So how is the present time for startup in the M&A space right now? And any closing remarks from your side?
Everything is getting digitized. If you're in IT, you are in hog heaven. You got everything. The world is your oyster. And if you are a real estate owner, a landlord, God help you. It's tough to watch. And I've seen 4 major accidents. Every 10 years, there's a major accident, be it the subprime, be it LDC debt, be it whatever it is, the currency crisis. And so, I don't know. There's no telling where we go from here, except it will be interesting. It will be intellectually stimulating. We're not going to get bored. Let's put it this way.
So, well, with that, on an interesting note, thank you very much, Professor Zahaby, for your time and talking.
You're very welcome. Thank you. Very engaging questions. I appreciate it. Thank you.
Thank you for your time, Professor.